One of the things I want to start with is that when I was provided the topic by, where's Kay?
Here.
Ah, there you are. When I was provided the topic about today's talk in terms of calling it the current economic crises and origins and circumstances and consequences, it was tough for me to pin down what I was going to do in the time I had allotted, because obviously we could do the whole thing on just the origins or the consequences, and we could have gone all day. So what I want to try to do for you today is I want to try to sort of pin down the major ideas that economists are looking at in terms of where we were, where we are, and where we're going. Talk a little bit about the fiscal cliff as a microcosm of a lot of things that have happened and are likely to happen. So one thing that the election did was it told us that there's probably going to be a little bit bigger struggle to try to figure out how we're going to turn the corner after January 1, because we know the Bush tax cuts are sunsetting, and we know that government spending is on a trajectory to go down, and both those things have led to the idea in macroeconomic circles that we're going toward a so-called fiscal cliff. Now, most economists believe that we're actually going to have some kind of a Hail Mary pass happen in Congress in the next few months to where the fiscal cliff will be sloped rather than a sheer cliff. But in either case, we got to recognize that a lot of the places we've been in terms of the current financial crisis and its ongoing effects are a function of debt. So I'm going to talk a little bit about debt, the nature of what debt should be doing in our lives, and where our public sector is not giving our households a great way of looking at the use of debt. And you're going to see two very similar pictures between the US situation and the European situation in terms of debt accumulation. And we're going to talk a little bit about how the Asian economies have both fueled and potentially generate the demand for that debt simply because they provided a lot of relatively inexpensive goods. Then when you jam all that together, a lot of what we're going to talk about is more philosophical than it is, let's say, empirical, in that we have to think about that we've had a philosophy of consumption in our country for a long period of time, and the easiest way obviously to fuel consumption when you don't have enough income is to accumulate debt. So those are some of the major themes that have lived through this financial time, or through our recent financial times, continue to linger with us, and will be with us for some time. So some basics just to get started. I taught a class in the Osher Lifelong Learning Institute at Sonoma State. It was actually at the Sonoma Mountain Village. I think it was 3 years ago now. In fact, I think it's just a little bit over 3 years ago, where I talked about economics at its core. In other words, rational decision making. We talked about things like murder as a rational act. And believe that or not, which has got nothing to do with macroeconomics per se. But the recognition that rationality can bring you some things that you don't like as a society. So we have laws up and we have regulations up against individuals rationally deciding on their actions and affecting society at too large a level. Part of that is because we have multiple markets moving at once, and they all are constantly giving each other incentives to change in ways that may leave society behind. The first one is financial markets. So all macroeconomies are made up of basically three major markets: financial, labor, and retail, or what economists call goods markets, where goods and services are purchased and sold. Okay? When you jam all those three together, you get the macroeconomy. And so when you're studying macroeconomics or you're reading about it after today, if you're studying, how many people are here are subscribing to The Economist magazine right now? Okay, so we got some, and you all sat in a cluster. That's weird, but that's fine. How many people in here have a terminal degree in social sciences? Whether it's psychology, sociology, political science, anthropology? Okay, a few of you. How many people in here have a terminal degree in economics? Outstanding, good for you. So macroeconomics, at the end of the day, is really a social science looking at rational decision making. And for macroeconomists, we look at these three markets. And everything you read in the Wall Street Journal boils down to one of these three markets or their combination. So we're going to continue to come back to these themes. But the bottom line, folks, is that all three markets are pursuing profit or benefit maximization. And it's a primal urge in all of us that it permeates everything we see as we move forward in markets. So you think about stock market movements. We say, oh, God, are we on the precipice of a bubble? The only reason that we're seeing stock market prices move around is because we have rational decisions being made about the future in terms of, if I have more information than you do, I have an incentive to exploit that for profit. And I'm going to come back to that idea about whether or not profit maximization is something that we want to really quell in our lives. because financial crises, in a sense, come on the back of the pursuit of maximizing profit. Keep that in mind for later. The other thing to think about as we've gone through what we've been through the last few years and before that in terms of how we grew into this situation and where we're going, will we see a repeat? There's a really good book out there called This Time is Different. Anybody get a chance to see that book, or anybody heard of that book by Kenneth Rogoff and Carmen Reinhart? Does anybody know that book? Okay, I know Ken's seen it. Okay, good. A couple of you have. Well, they actually just wrote an article in what's called the Journal of Economic Perspectives, and I'm going to talk a little bit, so I'm going to show you a graph about from that paper. They talk about basically 800 years of financial crises, and they really break it down. It's a massive book. But if you check out this book, it's actually a really nice read because it walks you through the idea that, in a sense, human beings, in that pursuit of profit maximization, accumulate debt and then get strung out too far on it. And by the time the financial markets realize what's going on, we go through a financial crisis to resolve or, in a sense, reallocate the resources that we're left with after we have this debt accumulation. And remember this, if I am borrowing money, what's got to be happening on the other side of that transaction? Somebody's got to be lending it. So what borrowing is ultimately is like risk sharing. So if you're willing to share risk with me in my consumption or my purchase of something, then it basically spreads that risk throughout society. And that's why a lot of us are exposed, indirectly or indirectly, to lending practices. And I'm going to show you some graphs later that talk about where the money supply has been, where it's gone the last few years in terms of, in a sense, reallocating resources in lending markets and where we are today. And this is one of the reasons why our economy is still very slowly reacting to the past few years in the recession, is because we haven't seen the cash that was generated by the Federal Reserve actually start to hit the street in a metered fashion. But one of the reasons we haven't seen it come out is because banks are not willing to take on a whole lot of risk right now and share that risk with us. So can we avoid a repeat? I say this in sort of rhetorical terms. We cannot. It's a matter of when it's going to happen and how it's going to happen. Okay? Keep that in mind. I'll end with that idea. So where are the crises? So the first crisis, it's sort of added, these are kind of 5,000 foot level ideas. The first one is that we saw ourselves building wealth in two different fashions in the last decade that sort of led to a cyclic end of a very long growth period in the United States and really in the Western world overall. That was exacerbated by the fact that we saw in a sense, the risk conditions that were happening in housing get undermined, and then everybody ran away from housing markets and equity markets simultaneously, which is a rare event. So at the beginning of the last decade, we saw a movement from equity markets into housing markets, and we were building wealth, not in the equity markets as much anymore, but actually in our homes. And some of us used that wealth we built and started to consume against that wealth. And what that did is it generated more debt on top of debt. And how do we intend to pay that off? Anybody have an idea on that one? How do home equity lines get paid off? Through the growth of home equity. Okay, so we take these and we assume that the equity we have in our home that acts as collateralization for that loan will remain in place. Well, as our equity goes away and we've spent money otherwise against the value of that home, our ability to remain liquid is reduced. And if that comes at the same time that we're having a natural cyclic downturn in our economy, we have what we at that time were calling, it was an illiquidity crisis. We saw, instead of having an infusion of money come in and save us and share that risk, we saw a lot of people retreating to cash, and we did not have as much liquidity in the market. And left me sitting there just as an example of a borrower, let's say, where I could no longer finance my way out of my choices. So when I was stuck making a choice of either walking away from my home or declaring bankruptcy or both. And then we saw housing prices tumble, which changed all of our wealth characteristics, and we exacerbated the natural cyclic recession we saw. But that happened through the financial markets, in a sense, commoditizing homes. Labor markets reacted by saying, well, if we're not going to see as much demand, then I need to contract my labor force, which then exacerbated the cyclic downturn as well. So the labor markets probably contracted more than they needed to get us through the natural cycle we were going to go through in 2007 and 2008, because we had this second issue going on with equity and housing markets. And now one of the big questions that's come in the wake of that, because we have not seen labor markets quickly rebound, is are we ever going to see them rebound? So we had 2 decades worth of unemployment at relatively low numbers nationally, state level, and certainly locally. If you look at the local markets, I mean, we're pushing out on 3%, 2.5% unemployment. How's that possible? Well, the idea is that we may have now a structural change in our economy where labor markets are not going to be creating jobs, reducing unemployment, generating long-term positions for a long period of time. We've also seen a switch over in hiring. So one thing you have to be careful when you read the newspaper. I get interviewed by the Press Democrat almost every month on the third Friday of the month because that's when the new labor data come out. But they come out only for payroll employment, not for payroll plus contractor employment. How many people in here have worked as a 1099 employee? Really? Come on now. Really? Nobody? All right, so that you just killed my whole point there. But let's think about it another way. If I'm looking at higher costs, let's call that Obamacare, and I'm looking forward, I'm saying if I'm worried about higher costs coming, or I have risk in taking you on as a full-time employee because I don't really know as well as I used to about the demand for my goods and services, maybe I'm better off taking you on as an independent contractor where I can basically cut the cord immediately rather than invest a lot of training and have to take on all the fringe benefits of a full-time employee on a payroll side, and I'm just going to hire you in a contract mode. And I might do that repeatedly. I might do it for a relatively long period of time, but folks, you don't end up on the payroll statistics that get reported in the paper when you're hired in that fashion. So one of the things that's going on specifically in the Bay Area is you're seeing firms as they're hiring certain positions in payroll because they want to keep those folks around, and other ones where they're worried about having to contract quickly, they're doing 1099. So there's a lot of high-tech jobs right now in, let's say, the greater Bay Area that are basically 1099 employment and are not full-time payroll positions. So to a certain extent, then that means that the economy has grown a little bit faster than maybe we think when we're looking just at the labor markets, and that takes us to the retail market to try to really figure that out. Now, one thing about retail is we've actually seen the consumer bounce back pretty well in terms of the last, let's say, 18 months. And we've seen housing markets, if you think about that as sort of longer term or durable retail, bounce back as well. Problem is that are we in a new culture in terms of consumption and savings? So if we earn income, are we actually now going to go into, let's say, a post-depression mentality of I need to actually save a little more because I'm not sure when the next crisis is going to come, and I don't want to overexpose myself like my parents did because I watched them go through, and when I say my parents, I mean, you know, generation X, Y, and potentially Z. But thinking about if I'm, let's say, between the age of 25 and 44, I might now have a different savings pattern than my parents did, who had a different savings pattern than their parents did. And it may be because we're seeing some culture change in the way that consumption and savings work in our economy. And I'm going to show you a little bit of data on that as far as the contraction of the amount of debt we're taking on. But remember, savings comes from 2 different sources. It comes from either retaining income or buying down debt. One of the two, it can lead to more savings. So what's tricky in economic data is that you look and say, okay, it looks like savings rates are up. Well, savings can either be that we actually are building wealth or reducing debt. And we have to watch which one of those is happening, because we're building wealth that has a completely different characteristic than we're simply just buying down our debt. Because one means we actually are building up to consumption later, the other one means that we're paying off consumption that we made in the past. So one thing we have to think about retail markets is, will consumption and debt accumulation walk hand in hand from this point forward, or people basically consume and live within their means, believe it or not? Okay? And that's something that if you look at the last, let's say, 30 years, culminating in, let's say, 2008 and 9, were we living within our means? And it's a very micro idea, right? Some of us, we know we were, but the macroeconomy and the forces around that can easily change your own wealth characteristics for the worse. So a lot of folks that were working, and this is something that kind of feeds back into labor markets, is that when there is when there's a recession, and let's say there's a contraction in demand, that leads to less profitability in businesses, which can lead to less profitability on equity markets, which can change the characteristics of my retirement, which then leads me to maybe not retiring at the same age, which then chokes off opportunities for folks that would naturally have come in to the labor market when you were going to naturally go out. So if retirement ages rise, which is going to be discussed in terms of Social Security reform over the next few years, or if retirement ages are naturally rising because folks don't want to walk away from their jobs because they don't want to now rely on their savings to feed them. They'd rather have income walking alongside of their savings for a few more years. The natural progression of our labor markets is choked off by the combination of those two forces. All three of these work with each other. When they're all three rising, when we see financial markets moving up in terms of equity values, when we see labor markets hiring and we see folks consuming, and they're all three moving in the same direction, we're moving into recovery and boom. But when any one of those three markets stumble, it puts us on the precipice of recession. And that's why the fiscal cliff is a little bit scary, because it tells us that there may be a contraction in labor markets. Public workers may see some loss of their jobs as government spending contracts and as county and city budgets contract alongside, which then permeate the other two markets. So we'll see how that goes. But in our mind, we have all three of those markets were working in reverse against the economy progressing to get us to where we were in terms of the precipice of the crisis. The major culprits, as far as becoming a little bit more focused and going from the 5,000 foot level down to, let's say, the 50 foot level, a lot of people like to blame that we had too much money. We were too liquid. And it gave us too much of a possibility of, in a sense, taking on risk, figuring that we would just get bailed out. So you may have heard this classic thing that bounces around economic circles of boom, bust, bailout, and then we're going to start all over again. Okay? Well, one thing you'd say is that the Federal Reserve should not be seen as a liquidity center for our banking industry. In a sense, that's what happened after 2008 and late 2008. We saw a conversion. I'll show you some graphs about this in a minute. That part of the story is sitting in there. There was a conversion of so-called toxic assets in banks to cash, and basically a trade from one balance sheet, the major banks on Wall Street, to the Federal Reserve, and who held relatively risky mortgage-backed securities, mortgages, and other housing market assets that had become or had been perceived by financial markets as now suddenly too risky. So one of the biggest landowners right now, technically in the world, is the Federal Reserve because of that trade. Okay? Now, think about that. Should we, in a sense, regulate the money supply in such a way to make it more predictable? So there's a cat and mouse game that gets played between financial markets and central banks worldwide, but really with the US Federal Reserve, that should the Federal Reserve be more overt in what it's going to do from every month in terms of, are we going to change policy? Are we not going to change policy? Rather than say, okay, we're not going to tell you anything, and then 8 a.m., the day we make a decision, we tell, and then the markets react, right? So countries like Norway and New Zealand have overt rules-based monetary policy that says, if we tell you that this is the data, this is exactly what we're going to do with monetary policy. Much more predictable. The problem is, and this has been a big debate in macroeconomics, is as soon as you go to what's called rules-based policy, where data tells you exactly how to react, you lose the discretion to intervene in markets when 12 people, the Federal Open Market Committee that makes the decisions about monetary policy in the United States, decides it's time to do something. Because the data may not tell them exactly what to do. It may say, well, maybe we should experiment a little bit. Do we like experimentation with interest rates? Well, I mean, they say that rhetorically too, but that's the point, is that we have to pick sort of one of two fates. Do we want monetary policy that's predictable, and thus financial markets that are reacting to what we would think of as a rational decision and rational expectations around policy? Or do we like the fact that we can be a little more episodic about it and attack things where 12 experts supposedly make that decision for our betterment? Well, we now have a lot of cash available in the United States because those decisions were made. Did we have too much in the first place? And do we have too much now? It may be that that's the case. And since we have so much right now, we're waiting for it. And this financial market is saying, well, until that money hits the street, we don't really know where we're going. I'm going to show you there's been a broad change in that. The second is we've seen a major changeover in regulations in financial markets. But you could say we got to the crisis in terms of 2008 because there was a lack of regulation in financial markets. We were providing loans to people who should not have been receiving loans. This is the classic story, and I'll review this in more depth in a minute when I talk about the American side of the coin here. But the problem is, folks, is we did, and how many people here worked in banking, let's say, between 1985 and 1995? Great. How many people got a loan for a home between those 10 years? Okay, that's probably, I figured a little more hands on that one. If you don't know, there was major reform in banking regulation in the early 1990s. On the heels, you may remember in the late 80s, where a lot of banks had failed, There was a relatively large financial crisis historically as well, but it was a little more brief in terms of time. But we had sweeping banking reforms in the early 90s as well. What happened? Well, what happened is we innovated around them. And how that innovation came to fruition is that we commoditized housing. We made housing more liquid than maybe it should have been. And as a result of that, now we have re-regulated, and instead of regulating just housing or just mortgage markets, we've now put a regulation around any financial transaction, including multiple order derivatives. So now if you want to do a 5th, 6th, 7th order derivative, and there's a lot of exotic financial assets out there, so if you're a mathematics person, believe it or not, there's 4th order, 5th order, 6th order, where you're just getting down to skewness, kurtosis, and on downward down the line as far as the deviations from the mean and returns on these assets. It is crazy, some of the mathematical models that are out there to try to gain just this infinitesimally small amount of marginal profit. But if I'm shoving $1 billion in one direction, I can squeeze 1/1,000,000th of $1 out of each one invested. Hey, that's positive profit. And that kind of takes us back to that original point: is profit max the problem or the solution? Or maybe it's both. Part of that is a culture we've had of instant satisfaction, accumulation, and spending and debt. Okay? We got snap purchases happening all the time. I have relatives who basically have gone into debt simply to consume at a certain level and be seen. It's in a sense conspicuous consumption. Anybody ever read a guy named Thorstein Veblen? Okay. That one of the biggest things he talked about was conspicuous consumption as a driver for why people consume and ultimately accumulate debt. Okay. Is that true? I mean, do you all feel like that we have a culture that wants to be instantly gratified? Okay, so how many people have got an iPhone 4 or 5 right now? Okay. How many people have a smartphone? Whether it's the Samsung, the Droid, or whatever. Okay, so I have a wife who has the 4S, right? She is never without that phone. Why? Because it instantly provides things to her. Oh, I don't know what's going on. Let's see. Or I need an answer to this question. Let's see. Can't wait to get home to get on the computer. Right? So if we're driving, it's like silence, except if I hear this. Right? And as long as 3G is in play, then there's questions being answered constantly. It's just part of our culture. We want to move quickly. Well, part of that is that we consume. Our government has consumed without considering the future to a certain extent. In other words, I'm going to show you some graphs about how far we are out on the tiles in terms of percentage of GDP and our accumulated debt. But it doesn't matter. So one of the things is that we can constantly refinance the debt. And the beauty of being a government borrower is that when the government borrows, it gets a lot of nice recycling effects from that, unless it's complete foreign ownership of the debt. But the cool thing is if you lend to the government by buying a government bond, I get to then tax you for most of those bond issues in terms of the revenue I give you. And so I actually get I get sort of an after-tax cost of debt that's better than anybody else on planet Earth. And so it gives a little bit of fuel for that, but we got to worry about paying it off. Again, believe it or not. Right? So a lot of sort of pop ways of explaining the financial crisis and where we're going is that have we done the right thing with monetary policy? Have we regulated the future in such a way that we will not see a repeat of this? And finally, does it matter culturally? Are we still going to want to accumulate debt? And as long as we go into an economic boom period, does it matter? Because won't we just sort of boom our way out of the problem? Okay. Well, let's talk quickly about the role of money. So one thing is we print too much of it, rates go too low. Do they really reflect the actual risk we're taking when we lend money? So one thing we may have seen is that rates were ultimately kept too low, managed at a low level to generate more spending, which didn't reflect the risk in that spending. Because remember, the interest rate ultimately is meant to be the price of the risk you're taking as the lender in providing cash, and to a certain extent as what the borrower should be risking by consuming today rather than saving. So did monetary policy provide us with too low of interest rate vis-a-vis what should have been happening? And the second, have we printed too much to where it's not going to matter and we're just going to basically be leading to another crisis? So I've done about 100 and... Oh, did you want us to ask a question?
Yeah, I mean, you summarized the reasons why people, but I think you
Sure. So I can get down to specifics. We've financed a whole lot of things as a government, right? But my whole point about it is the government financed those things assuming we would basically grow our way out of it and pay it off later because we're going to have enough income to do it. Doesn't really matter what we're financing. You're correct that might be one of the reasons that it happens because we're financing something that happens overseas to a certain extent, if that's where you're driving. But the bottom line is that if we stop those wars, it wouldn't necessarily stop the problem. Okay? Not necessarily. It might. But it doesn't mean we wouldn't find another home to spend. Okay? And that's my point. I don't want to get too down in the specifics. We don't have enough time. We could have done the whole thing on why we financed our wars and why it's killing us financially if you'd like. But I don't think we want to get in that today too much. Bottom line is that we printed too much money in an attempt to get out of the crisis. And folks, what happens when you print too much money? Just intuitively. It undermines the value of your money, and it can lead to one of two things. Either too low an international value of your currency or ultimately inflation, one begetting the other. Okay? Why have we not seen inflation pressure in the United States yet?
We are.
What's that?
We are seeing inflation.
Are you?
Yes, indeed.
Wow. Okay. Data don't show that, but okay. Do you really? Wow. The question was, well, my question was answered, but the point was that what does it cause when you print too much money? Inflation ultimately. But what's got to be true about that money? When you print the money, if it goes and sits someplace and doesn't actually become new borrowing, a conversion of one asset to the other that fuels more spending, there's not going to be much change in prices. So folks, when I say inflation, I don't mean 1.5% per annum. I mean 2.5%, 3.5%, 4% per annum. That's when policymakers start to react. As an economist, I don't care about 1.5% inflation. It doesn't bother me. Okay? I don't even care about 2 that much. I care about 3, 4, 5 and up. All right? But the point is this, we haven't seen that kind of pressure. The other reason is because we've still seen the consumer contracting a little bit, and we're not seeing consumption going as fast as it could be. Part of that is going back to the fact that the banks are not lending money out as quickly and not taking as much risk, and one begets the other. So once the banks start to give a little more risk-taking to businesses and consumers to borrow and spend more, inflation is going to then become the problem. Okay? The funny thing about it is Ben Bernanke has written for years about this so-called credit channel of monetary policy, where banks and their decisions about what to do with new money that's been printed by central banks may in fact control the pace of inflation. By simply saying, hey, that's great, you gave us the money, you traded us securities for money, great, what if we just sit on the cash for a while? That slows that pressure down to a certain extent. Okay? So we'll see. We still have a long way to go, and these graphs I'm going to show you in a minute will put that out there. A lot of people have argued with me that going back to a gold standard would solve a lot of these issues. How many people have invested in gold in the last 4 years? Good for you. Good for you. Okay? So is that the right play, though? Is gold the answer? What if we had global fixed exchange rates? Is that the right thing to do? It ties monetary policy's hands to a certain extent. Okay? Of course. Guess what? Everything does. It's called opportunity cost. Okay? The beauty of flexible exchange rates is that you can have times like these where if the value of the dollar internationally goes down, what do we get as a nice perk for that loss of value? We get exports, and we've seen that happen. Okay? We can also, when we have global fixed exchange rates, we can actually take on problems that happen from other countries because they'll basically transmit their problems onto us, and we won't have a way of getting out of it. To a certain extent, Germany and France are feeling that effect right now because of the peripheral countries in the Eurozone spending too much money and pushing the way to get out of it onto the German and French economies. In other words, the German and French economies, in a sense, have to suffer to pay off the debt accumulated by Italy, Portugal, Spain, Ireland, and Greece. Okay? If exchange rates were flexible in the Eurozone, those 5 countries may see a real wild recession where Germany and France might be somewhat buffered from it initially. But right now they're all going to have to go as one big fat ship. And we'll see how it goes. But these are in a sense the options you have. A lot of people, and I put that on there because I figured I'd actually get more action. A lot of people say, "Yo, absolutely, let's go back to a gold standard. This is ridiculous." But you all undermine me on that one. One other thing I hear a lot about is in the role of regulation, should we have not repealed the portion of the Glass-Steagall Act that allowed banks, insurance companies to commingle funding? Okay? So, in other words, would that bring a bunch of additional cash into play? One thing that comes up at the really micro level is that what happened in the housing crisis, ultimately, and what happened in our financial crisis, that we had a lot of these so-called credit default swaps. What's a credit default swap? Does anybody know? I know a couple people in here have educations in economics. Anybody want to roll the dice and remember what that means? A credit default swap? Go ahead, Ken. It is on what? It's a type of insurance on... Well, credit default swap kind of gives it away. If the credit you provided defaults, there's basically insurance on that default. Okay, when defaults happen in mass, and I say, well, look, I'm covered, right? I paid you a premium to cover me against this credit defaulting. Well, now I've got to come up with, as an insurance company, with a lot more cash than I expected, and that can bankrupt me. So we have financial institutions on both sides. Lending institutions, banks, and then insurance institutions, the ones that provided, in a sense, insurance against the default, both going down simultaneously. Okay? Lehman Brothers is a classic example of this. If you remember when Lehman failed, it's because they were overexposed on both sides. Okay? So a lot of people believe that if we kept those things separate from each other and didn't allow the cash to move, and a lot of it was made easier because I had an insurance company and a lender underneath the same bank holding company, and I could price the credit default swaps real low. So basically I could lend, and if Fannie and Freddie didn't pick up the house I lent against, then I could always insure it against the other portion of my business. Okay? So we have a local citizen, as you probably know, who is part of this situation, who's financed a lot at Sonoma State now, who's blamed directly for a lot of this. Well, folks, bottom line is that, was it really the repeal to blame? And the answer is it might have exacerbated the risk, but it was not the key. It was not the linchpin in why we saw the financial crisis take place. I want to dispel that. Okay? This was a change in regulation that took place in 1999, and it certainly fueled how we spent and how the housing market went, but was not the linchpin failure. Now what we've done is we've actually re-regulated. On July 21, 2010, we saw a 1,200-page document get signed called the Dodd-Frank Act, and it's meant to be sweeping financial reform. Folks, in 15 years, if I'm back here and you all are here, we'll be talking about how Dodd-Frank was circumvented for the betterment of the financial markets. Okay? There are hundreds of people working around the clock to try to figure out how can I go around these regulations and profit somehow. Okay? And it happens every time there's financial regulations. It will not solve the problem. Okay? Philosophically, what's going to solve the problem is that we need to live more on our means. Believe it or not. Okay? Let's look at some graphs. The first graph is the amount of cash available to lend by banks and credit unions in the United States in the aggregate. Total cash available. Okay, between January 2000 and August 2008 in the first panel. Okay, notice there was 1 month that was episodic in terms of banks bringing in cash and deposits and pushing it back out the door in loanable funds that didn't quite make it back out the door. 1 month we got about 15 billion total US. Total. What month? September 2001, right? And it's relatively obvious why we saw some reticence in lending in the weeks after 9/11. But folks, notice that there's one dot. If you can see that, there's one dot here, okay? And then we're back on track. And if you take this data and you go back in time, it really doesn't come outside the bounds of $0 to $4 billion in inflation-adjusted terms going back to 1970. And I'll show you a graph that shows you limited amount of that history. But the bottom line is that the banking model of lending is to bring in cash and lend it back out, where the differential is the profit made on each dollar lent. technically, or at least the gross, let's say the gross profit. Then you take all your overhead out of that. But this is relatively normal. Now notice, as we got closer to August 2008, it became a little more episodic, but not by much. We had a little bump in the road here and there, and off we went. Okay? And we know there a lot of lending was happening at that time. To capture all the data on this graph, I needed $18 billion inflation adjusted. 18 billion. Keep that number in mind. Here's what happened from January 2008 forward. Now, if you notice, a couple things are going on in this graph. First thing is to grab onto all this data. Now I needed $1.8 trillion, or 1,800 billion. Okay, so remember, this was 18 billion. Now we have 1,800 billion. Okay, September 2008, right here, this is when Lehman failed. October 2008, we saw a flood of new monetary programs and policies begin, which continued basically through this portion of 2009 and this portion of 2010. But this is the amount of cash that started to compile in banks. Part of this was the conversion of so-called toxic assets, mortgage-backed securities held by banks, and both in mortgages and in financial markets, converted to cash, going into bank accounts, and then turning into a reticence to lend. The second was the accumulation of corporate bank accounts, as there was some recovery during 2010 and the early part of 2011. But notice what's going on here. 2008, the remainder of it, 2009, we saw an accumulation against lower risk in banking. 2010, which was the beginning really of our recovery out of the recession, we saw that gradient get a little bit better and start to slow down. Now, I've shown this graph 140 times in different crowds. Okay, so I've been showing this, I've done 140 of these since, let's say, 2009. Okay, and I've shown this graph for some variation of it, and so I get very careful. I try not to say that we're out of the woods here, right? But this looked pretty good for a while. Then right after the Japanese earthquake and the Arab Spring of 2011, things didn't look so good again. And then after those had kind of cleaned themselves up, we went into 2012, and it's been a little bit rocky, but we're slowly sloping down again. Folks, we are right now just around, if I can find my arrow again, right there. The beginning of November 2012, we're right around 1.4 trillion in cash on behalf of banks and credit unions in the United States overall. Okay? Now it makes you wonder, why is all that cash sitting there? Two reasons. One, banks are still reticent to lend because they're worried about the rate of return they're going to get on the other side. The second is that somebody's paying them 1/4% to keep that cash where it is. Who's doing that? The government's too general. Close. The Federal Reserve is more specific. The Federal Reserve, who generated the cash in the first place to swap out the balance sheets of the banks, now pay the banks 25 basis points to keep the cash where it is. There's been a lot of talk in the Federal Reserve and in monetary circles that maybe what we should do is pull the 25 basis points away and see what happens. Okay, but that'd be a hardcore experiment, okay? We'll see how that goes. But anyway, folks, this is the current cash situation. Now, this is the historic look at it, where this is now 9/11 in historic perspective. My circle's a little off, but I'm trying to look on that bump. Okay? You see that bump? Yeah. Barely bumped, right? Now remember, 2 slides ago, this was the most episodic month, okay, in 30 plus years of data. By far. And this was a movement, folks, from about $1 billion to just under 16, about a $15 billion move in 1 month. This move from right here, let's say just here in some random month, January 2010 to February 2010, where'd my arrow go? Just these 2 dots was about 95 billion. Okay? Complete different way of looking at the way cash is moving into our economy from the central bank. Okay? But a lot of this is because cash has become king. We're waiting on the sidelines to figure out where the best risks are, and this tells you that we're still struggling with that idea. Part of it is because we put a lot of money in the system, and there's still a lot of risky assets out there. The second is that the regulatory environment has changed in such a way that I'm not really sure what the best profitability is once it moves out. Well, am I facing higher regulatory costs in lending? The answer is absolutely. Talk to your local banker about how things have changed since July 2010 in terms of moving cash out the door. It's gotten harder. Okay? That's on the monetary side. Now let's look on the real side of the economy, or where goods are provided, and see if we can't find something else going on here. Why are we still lingering in sort of quasi-recession, or a quasi-recession in terms of the United States? There's still a lot of recessionary forces out there. Part of it is in terms of investment. Investment, the purchase of new plant and equipment, the accumulation of inventories, and the construction and sale of new housing are in sum the way that macroeconomists measure investment. You can split those into two buckets: the housing bucket, which we're going to call residential, and the non-housing bucket, the purchase of new plant and equipment and the accumulation of new inventories, which is this, non-residential. And you can see that this has very nice cyclic properties. Recession, long boom, 1990s, recession.com, decent boom last decade, pretty big recession, recent recession, and decent recovery. So is the American economy in recovery? And the answer is absolutely. These investment numbers tell you that we're seeing some accumulation of business spending on things that make income not now, but actually in the future, which means they're hiring against it. Now, if I showed you a bunch of labor market data, the same thing would be true. Okay? But this is a little scary, that we've actually started in the third quarter, which is not that long ago. This is June, July, and August of this year, or I should say, I'm sorry, July, August, and September of this year. We actually saw negative growth in non-residential investment, but we've had growth before. And you can see in the past, we've had some negative growth, but usually not during a relatively good boom period. We had one here, but both these show you there's a little bit of bumpiness on the road. Okay? It could be because of the election. Well done. Whoop. This is residential. Okay, so this is housing. Anybody remember the early 1990s and the value of homes? Okay, well this is one of the reasons why home values then affected our economy, and we saw a relatively decent recession. We saw some choppiness at the beginning of the 90s, and then we saw a really nice long boom period in residential investment. We know that this happened. This is the scary part here. Okay, and then we saw some choppiness coming out of the recession and into a boom period. But the bottom line is this, is that if you look at this and you say, God, you know, that seems like it tells us a lot about the recession. Residential investment is not an enormous part of our gross domestic product, so the percentage of this as a percentage of GDP is not that big a deal. The problem is how many other industries were wrapped up around housing where you weren't really building homes, but you were building services around the housing industry that decline, that don't show up on this graph. Okay? So the choppiness, I mean, really, we've been in a housing recession since early 2006 in the United States, and it still kind of lingers with us. As far as the net change, we're not even close to where we need to be. Okay? But that really depends on how you view housing in our lives, right? How many people here have moved down in terms of housing cost in, let's say, the last 10, 12 years? Okay, my guess is in this room I was going to get a lot of hands. That's good. Okay? But is that trend going to continue? Are we going to still look for the 4,000, 5,000, 6,000 square foot homes that have an enormous amount of services that come alongside of it? Or are we going to start to see smaller footprints demanded? A lot of that's unknown. So with that, there's been a little bit of slowness getting back into building homes because we're not really sure. Think about commercial real estate. Did we overbuild commercial real estate? Okay, because we didn't realize, I think 10 years ago, how much the technology was going to change to not necessarily force you into commercial space when you start a business or expand a business. The second is that we may see a culture change, and even if I needed or have historically needed commercial space, who wants it anymore? And if I want it, I want Class B space. I want simple space. I don't care what the carpeting looks like. I don't care if there's somebody out in front. I don't care about any of that crap. I just need a room with a whiteboard and a table and microwave bandwidth. And if you give me all that, I'm good. And if you talk to people in San Francisco that are starting high-tech businesses, that's what they're looking for. They're not looking for the office space when you walk in, there's 4 people at the desk, there's a greeter with a glass of champagne when you walk in, and there's a janitor constantly vacuuming the front because they're paid to do that in Class A space. Now, I'm doing this on the phone and I'm doing this with my carpet sweeper because I'm trying to make things happen. And now we're seeing that if you look at the statistics, there's still about 21% vacancy in Class A space in the Bay Area. It's about 8% in Class B. And it's going like this in terms of growth. Because Class B is where all the action is. Now that may go into Class A over time, but the two markets are kind of walking side by side. It's very slow movement on both. Now, let's talk about some generalities, and I'll start getting to sort of the more meat and potatoes of the ideas and wrap up. Is greed bad? What do you think? And I say this rhetorically. I figured this would lead to a lot of discussion. But profitability does not necessarily equal greed. How many people would be here if it wasn't for corporate America in this room? How many people? How many people here own stock? Okay, that answered my question. So, would your children have gone to the university they went to if it wasn't for the profitability of firms? So what a lot of people like to do is say, you know what, I don't like the fact that corporate America is greedy, right? What's the alternative? North Korea? What do you think? And I'm trying to wake you up. Hopefully some of you haven't gone to sleep yet. But one of the points here is the idea that we immediately point the finger and say it was greed that got us here. Folks, it was greed that got you to the peak too. Okay? And you got to keep that in mind. That if you think of greed as corporate profits, you're losing the point. Greed is the pursuit of profit maximization that is innate in all of us. Okay? Can't get rid of that. How many communist or very far left socialist governments have survived long term without having basically a totalitarian state? Very few, because people want to move forward naturally. Okay? The problem is that when you regulate, you got to regulate in such a way that sort of boxes people in to how far out they can go, which is why I told you before, in 10 years if we do the same thing, I'll tell you how people got around the current regulation, because there's a profit motive to do so. Okay? Feels like I'm losing this thing. Can y'all hear me okay still? Okay, great. So one thing we don't want to do is we don't want to conflate the idea of greed with corporate decisions per se. Okay? We have to figure out how we're going to do it, and it's very, very tricky. We love to, have a glass of wine in our hand and talk about how greedy people are. Yeah, we're going to be talking about the same thing in 100 years. It ain't going to change. Okay? So credit, consumer credit, and the over-provision of credit could be a way of looking at greed. Here is the movement, and I took this chart directly because it was hard for me to really capture this any other way. This is the movement of consumer credit as a percentage of GDP since 1970, where the shaded sections, hopefully you can see those shaded sections, are the declared recessions by the National Bureau of Economic Research and the timing of those recessions. So you can see that almost every single recession since 1970 has had afterward a reduction in the amount of consumer credit. Now, does that make sense? And the answer is sure. We overspend, we get ourselves into either an inflationary situation or an inability to pay back. There's a contraction of both spending and lending in such a way that we are forced to do this. On the household side, okay? This is US public debt as a percentage of US GDP. Notice that from 1980 forward, where, remind yourself that we had a couple recessions here in the 80s and early 90s, where we actually saw consumer credit go down. Well, on the government side, we saw it go up, peaked, and when we started to cut back on military spending, which is kind of your point about maybe the war financing is one of the things that leads to a debt accumulation, we saw that go back down. And then once we started to finance the wars and we started to increase government spending overall, we saw it go back up. And this is what's happened since 2008. And this is where it's projected to go to 2017 by the Congressional Budget Office in its current state of affairs. Okay? So I don't see a lot of downward movement in that versus what I see here with the consumer in the wake of the recession. So this is the American story. Now let's look quickly at the European story, first piecemeal and then together. This is the European story. Yes?
Before you go on, when that curve goes up about, when is it, 2007?
Yep.
What was all that increased spending for?
This is the Obama entry into the White House. This initially was the Bush tax.
Well, it's too simple to say that's Obama. What was the spending for that this went up?
Partially it was for military. Partially it was Bush tax in 2008 and the refunds, and the other part was the ARRA money that Obama and Congress spent starting in February 2009. Some of those parts. Correct. So you had both numerator and denominator problems. Very well done. Oh, great.
Probably.
So with that in mind, right, and we've had other periods here where we saw slowdowns, okay? This is the European situation, and I put that demarcation line at 60% of GDP for a reason. So this is a little harder to see, but just I'll say these out for you. This is Italy, Greece, Ireland, Spain. Do you see a theme growing here? Okay. But that these are also France, Germany, and notice that Spain and Ireland are, as of 2004, the only two in the set of the economies of Europe that actually were underneath the 60% debt to GDP ratio. Folks, that 60% has significance. That's part of the treaty that keeps the euro together, is that countries were supposed to be underneath a 60% debt to GDP ratio to remain in the euro area. Well, the two that are below, ironically, are Spain and Ireland, which now none of these are below. Okay? So while Germany and France have given a lot of lip service to the violation of the treaty that keeps the euro together to the so-called pigs nations, one of the tenets of that treaty, one of the 5 major issues, one of them being the 60% debt to GDP ratio, has been violated by all of these countries. Okay? Does this put pressure on your economy in terms of the currency value and ultimately in terms of your ability to pay back your government spending? And the answer is of course. Okay? The problem is that the spending decisions are not originating in one place. They're originating in 17 different places in the euro area, which is one of the things that Europe is likely to look at, is whether or not they need to go into a fiscal union to keep themselves together. This is what the public debt, in terms of the Eurozone debt, the 17 countries together, or the euro countries over time accumulated, and you can see the same basic trajectory as the US applies. Okay, which has nothing to do with military spending whatsoever. So, quickly, the American version of the crisis we've talked about already. It basically was a perfect storm of a natural cyclic recession that had housing and equity markets contracting simultaneously and led to all 3 of those major macro markets going down at the same time. The aftermath is that we're still sorting out a little bit. Notice that last point I make. Unfunded but known future liabilities in the public sector. So while we're sorting currently, 10, 15 years from now, we have liabilities coming, and it's not just our pensions. It's Social Security, it's health care, it's other things we know are coming that we're going to have to spend on as a public, if you will. Okay? Could be. It's another one of those. The European version. The European version of the crisis is that Europe was exposed to the American financial markets. So it was naturally going to go down. We got a cold, a real bad one. They caught it too. Okay? Now, the other thing, like I said before, one of the things about government debt in the euro area is that there's 17 decentralized decisions about spending that then rely on one central decision in terms of potentially financing it through an increase in the money supply, which in macro circles is known as seigniorage profit. Okay? And when you're basically using the money supply to pay off government debt, you have to have some command over how much debt you're continuing to accumulate. Or one will just basically walk together with the other and you'll cause a lot of inflation. So why is there a lot of talk about recession in the European or the Eurozone? Is because instead of walking down that line, they're going to experiment with what's known as fiscal austerity, which basically means you're going to look at higher taxes and lower spending and start to reduce your debt load. Well, guess what we're doing on January 1 if nothing changes? We're going into a similar experiment. Okay? So what happened ultimately is that governments increased their currency risk by passing it on. In other words, hey, we now have the same currency. So if I spend a little more as a government, guess who gets to pay it? You don't think the Italian government knew that when they increased government spending in Italy, it would, in a sense, transmit itself out into the Eurozone otherwise? We all knew that. That's why that 60% was in place. Okay? And they all violated it. Problem? Unfunded but known future liabilities in the public sector. Wonder why I said that there too. Well, let's talk about the Asian version. Okay? Asian countries have grown very well and in fact bounced back after our recession relatively well. 2 successive boom periods in the West were used for their betterment. There's been major migration into the cities, a lot of cash moving into East Asia. Great. They own a lot of foreign debt. Well, guess what? The Asians also have unfunded but known future liabilities in the public sector. Okay? Now, if you want to try to pay off liabilities, what's one way of potentially doing that in the short term? What's that? You can tax, right? But tax is usually a political problem, right? Can you borrow in the short term in the hopes that you either grow yourself out to be able to pay it off? How do we do it at home? How many people have bought their home for cash? You don't have to raise your hand. Okay, but a lot of us borrow to buy our home, right? That immediately leads to a future liability that we assume we're going to have enough income to pay off. Governments work in a little different way in the sense they can hit the printing press on the money supply, but the bottom line, we know these things are coming. The Asian version of it, the one-child policy in China is leading to a major social security crisis in China because they're going to have a bunch of people who can't work anymore and a sort of population that, in fact, is going to be much smaller to finance it. We will see how that goes. And this brings us back to our original point. In economics, there's this idea called duality, that whether you look at the maximization of profit or the minimization of loss as your focus of your everyday activities, you can end up at the same basic place as long as you're making rational decisions on both sides. The problem, it's very difficult to make what you could think of as pure rational decisions because we don't have enough information to do it. And there's 2 things that come up that you could say really led to this financial crisis and it still is with us today. One is that we did not screen the way we lent money well. We did not realize that people who were signaling that they were good borrowers were actually bad ones. Okay? And then once we gave them the money, even if they were good borrowers, we may not have foreseen what was going to happen to our equity portfolios in such a way that in fact it reduced our incentive to pay back the loan once we received it. So did good borrowers lose their homes in this financial crisis and in a sense exacerbate the problem and it continues to linger with us? Absolutely. And some bad borrowers as well. Okay? So the regulatory environment, the monetary environment, and in general our economic environment has got to react in such a way that we recognize that we're trying to reduce these problems because the sum of those 2 problems together is really the risk we face in financial markets, but that they're all tied. We can't look at financial markets by themselves, we can't look at labor markets by themselves, and we can't look at retail markets by themselves. They're all intermixed. That paper I talked about initially, right off the top, is this, just came out in 2012, but it really is based on this book called This Time is Different. The idea that when you have public debt rising rapidly, that you end up with what's called an overhang, that when it goes up too high and the economy begins to go into recession, there's this lingering effect for years. They looked at 26 debt episodes and suggested that when the cumulative debt, like the pictures we saw in public debt as a percentage of GDP, go beyond a point that leads to some kind of a financial crisis, it may take 5 to 15 years to get ourselves out of it historically. Okay? The average debt overhang, they say, is 23 years historically, since 1800. Okay? But the real bottom line, there depends on how real interest rates react to that. If real interest rates begin to spike in reaction to increased risk, it can lead to reduced investment, reduced spending for long periods of time. Okay, in the United States, we've actually done a pretty decent job in managing real interest rates. But the problem is that we're not pricing risk very well yet. So even at low interest rates, we as borrowers aren't knocking on the door and demanding loans. And banks have a disincentive right now to lend money because the riskiness of us as borrowers has not really gotten better. Okay? Does it imply the immediate need to reduce public debt? Okay? So private debt has started to contract. We've gotten better as consumers. Public sector still has a lot of things coming. So when you think about the origins of the financial crisis and the potential consequences of it, folks, we might be in the beginning of a long period of debt issues in the Western world and really globally, that where we may have to see slow, small rates of growth for some period to come. One of the conclusions I keep making about the American economy is we may have to go ahead and get comfortable with the idea that we're going to grow more like the European area has historically, rather than how we have historically for the next generation. We may have spent ourselves into that situation, which a lot of people don't like to hear because that means higher unemployment, slower growth rates, but some command over inflation. So ultimate concerns, what's going on? One, folks, we have not had a generalized technological advance that helped us in the 80s, the 90s, and the last decade. It has not emerged yet, if it's going to emerge anytime soon. We know there'll be tech advances that are generalized at some point. But we got a little spoiled the last 30 years that when a tech advance hit, it seemed to move into other sectors, grab them, and pull them very quickly upward and go global in terms of marketability. Okay? I keep talking about the commercialization of science as being the next one where it's actual scientific problems, not where I'm taking computers, per se, and putting them into homes. That solves a problem of entertainment. It doesn't solve a biological problem. Okay? So we will see. We're going to have some biological problems we need to solve in the coming years, because we got a lot more people coming onto Mom Earth here, and we'll see if that actually leads to something going on in the scientific world. Couple things to think about. One, I also get asked if the major foreign ownership of American debt is an issue. And the answer is the Chinese economy has no incentive to drop a $4 trillion bomb on the United States by saying, you know, we're good, we want to sell everybody on tomorrow. We're going to open up the auction desk tomorrow morning and $4 trillion, we're done. Don't want to have it anymore. What will happen is a gigantic, basically, movement of wealth from one side of the ocean to the other. Yes?
Give an example of what you mean by that phrase, generalized tech advance.
Sure. When you have microprocessing speeds get faster, which helps businesses work more efficiently, it helps households work more efficiently, and reduces costs and increases productive capacity across the economy, as an example. Or the proliferation of broadband can have that kind of advance because it opens you up to more productivity and more efficiency. That's what I mean by that. Does that help?
Yeah.
Okay, so the question was, what is the idea, or what's an example of a generalized technological advance? Something that moves businesses and households forward in terms of efficiency simultaneously. Okay? The other thing is that housing's still slumping, and folks, we shouldn't expect housing to take off like a rocket ship anytime soon. And finally, we cannot spend our way out, and I'm biased on this, but we have to educate our way out. We got to get better about financial literacy, we got to get better about scientific education, and we got to get better about what a house really means in your overall portfolio. And that's all I got.